Welcome back to Iron Financial. This is the only place where we forge stronger portfolios by stress testing the market's biggest weaknesses. Today, we are putting a really fascinating company on the anvil, HeartFlow. Ticker is HTFL. Now, they just dropped their earnings report, and on the surface, everything looked absolutely solid. But the market's reaction? Well, that tells a completely different story. It is a classic earnings paradox, and we are here to hammer it out and see what this company is really made of. Let's get to work. Okay, let's just dive right into the core mystery here, the thing that really caught our attention. So HeartFlow steps up to the plate, and by all accounts, they deliver a stellar quarter. I mean, they beat analyst expectations on the top line, revenue, and they beat them on the bottom line, earnings. Now, in any kind of rational market, that is the perfect recipe for a rally, right? You absolutely expect to see the stock get rewarded for that kind of performance. But that is not what happened here at all. The market took one look at the plint, kind of gave a little head fake, and then almost immediately started to question the structural integrity of the entire story. So, what gives? All right, analyst, enough with a narrative, okay? Let's put some hard numbers on the anvil. Let's look at this. The street was braced for a 15-cent loss per share. That's what everyone was modeling. HeartFlow comes in with only a 12-cent loss. I mean, that's a beat. It's plain and simple. Now look at revenue. Analysts were looking for, about $47.5 million. HeartFlow delivers over $49 million. That's another clean beat. And yet the stock goes absolutely nowhere. It even dipped in aftermarket trading. This tells me the market is looking past these headline wins. It sees something else, something deeper. So what is the real story hiding behind these numbers?
You're right to be skeptical. And that's exactly why we're going to deconstruct this whole thing piece by piece today. First, we're going to forge the top-line growth. We need to understand the bull case, the momentum story. Then, we'll do what we do best here at Iron Financial. We're going to stress test the foundation. We're looking for any and all cracks. From there, we'll examine their master plan for building what they claim as a defensible moat. And finally, we will bring it all together for the iron verdict.
All right, let's kick things off with the bull case, because you really have to give credit where credit is due. Before we start looking for weaknesses, we absolutely need to understand the source of this company's power. And for a company like HeartFlow, that power is rooted in raw, undeniable top-line growth. This is the heavy lifting phase of their story. This is where they're proving that there is a hungry market for their technology. You can think of this as the steel frame of their entire bull thesis. Let's start with the absolute foundation of any bull case, revenue. The first pillar we see is this number right here. $49.1 million in a single quarter. Now, this isn't some small, insignificant number for a company at this stage of its life. It tells you their product isn't just some science project stuck in a lab. It is a commercial reality. Real hospitals and actual physicians are writing very real checks for this technology. So this figure, it represents tangible, growing demand in the healthcare marketplace. It's the first major proof point that their product has actually found a true market fit. And you have to understand, this is not just some one-time surge. What this chart shows us is the trajectory, the raw power behind that growth. We're looking at a 40% increase year over year. I want you to really think about that for a second. In just 12 months, they've expanded their revenue from around $35 million to nearly $50 million. That is explosive acceleration. This kind of momentum is exactly what separates the high-growth disruptors from the rest of the pack. This is the kind of powerful, sustained growth that builds real market leaders over time. So the big question is, how are they achieving this kind of incredible growth? Well, it's not magic, it is pure execution on the ground. And this number tells that story perfectly. They added a record-breaking 340 new accounts in 2025 alone. Now listen, this isn't just about selling more product to their existing customers. This is aggressive, relentless expansion. They are planting their flag in new territories, hospital by hospital, clinic by clinic. They actually closed the year with nearly 1,500 accounts in the US alone. This is how you build a commercial footprint that's designed for long-term sustainable dominance. And look, management is standing firmly behind this aggressive strategy. These are the exact words of their CEO, John Farquhar, pulled directly from the earnings call. When a leader goes on the record with this level of conviction, it really carries weight. He's not just saying he's confident. He's saying he has never been more confident. He is putting his professional reputation squarely on the line, telling investors that the foundation they are laying today is going to support a much, much larger structure tomorrow. So that's the bull case in a nutshell. Powerful growth, rapid expansion, and unwavering leadership. Okay, hold on. I've heard that story a million times before. Oh, we're building for the future. Don't worry, profitability will come later. That is the anthem of every single growth company that ends up burning out. That top-line growth is the shiny steel skyscraper they want you to look at, right? But I'm the inspector who goes down into the basement with a flashlight. A structure is only as strong as its foundation. So now it's time we stop admiring the view from the top floor and start stress testing the concrete. Let's see if we can find some cracks.
And you know what? We didn't have to look very hard at all. Here is the first major stress fracture, and this is pulled directly from their own 10Q filing. That's the detailed quarterly report they have to submit to the regulators. For the first 9 months of 2025, HeartFlow posted a net loss of $92.4 million. Just let that number sink in. While they were out there celebrating all that top-line growth, they were burning through an absolutely astronomical amount of cash just to achieve it. This is not a small leak, my friends. This is a gaping hole in the hull of the ship. This is the market's primary concern right here.
So let's break down where this financial strain is actually coming from. The net loss, that's the big headline number, but it's fueled by real-world spending. Their operating cash flow, that's the cash generated from their core day-to-day business, was negative $43.4 million in that same period. This means that every single day, the basic function of their company is consuming cash at a furious pace. And you can see on this chart exactly where it's going. A huge chunk of their cost structure is being poured directly into sales and marketing to acquire all those new accounts we were just talking about. The core business is a furnace, and it's consuming cash to fuel that top-line growth. And what's the consequence of all this cash burn for the actual owners of the business, the shareholders? Well, this slide tells you everything you need to know. A negative 49.25% return on equity. In simple terms, this metric tells us how effectively management is using shareholder investments to generate profits. And right now, it's saying that for every single dollar invested, they are actively destroying nearly 50 cents of it in this pursuit of growth. You cannot call it building a business when your own financial metrics show you're actively demolishing shareholder capital. This is a massive flashing red flag.
Now, a bull will immediately pivot at this point and tell you to look at the balance sheet. They'll say, hey, don't worry about the burn, look at the cash. And, to be fair, they do have a point. The company is sitting on nearly $328 million in current assets, and that's primarily cash from their recent IPO, against only about $38 million in current liabilities. On paper, that's a very strong cash position. But here's the thing. Cash isn't a moat, it's ammunition. And at a burn rate of over $92 million in just 9 months, that ammunition is being fired off at an incredible speed. The real question isn't how much cash they have today. It's how many quarters of runway that cash buys them before they have to either turn a profit or go back to the market, cap in hand, asking for more.
You're focusing on the quarterly construction costs, and you are completely missing the fortress that is being built here. Yes, it's expensive, of course it is. Building something truly dominant always is. I mean, look at history. Amazon wasn't profitable for years and years. This isn't about the cash burn in a single quarter. It's about erecting an impenetrable competitive moat that is going to generate cash for decades to come. Any competitor who even thinks about looking at this space will see that the cost of entry is absolutely astronomical. That's not a weakness, that is the entire strategy. And let's be extremely specific about what this moat is actually made of. This isn't just about having a good product. First, and this is the most important part, it's about data. They have what they believe to be the world's largest proprietary database of annotated CT images. We're talking over 160 million of them. Any AI model is only as good as its training data, and HeartFlow has a massive proprietary head start that's nearly impossible to catch. Second, clinical evidence. They have literally spent decades generating the data to prove their technology works, which is a huge, huge barrier in the medical field. And finally, they have a proven go-to-market model and are deeply integrated with commercial partners. You can't just replicate this entire ecosystem with a better algorithm. It is a multi-layered defense system. And they're not just defending their position, they are actively expanding their territory. The next phase of their dominance is centered around this brand new product, Plaque Analysis. Now, this is a potential game changer. It's designed to analyze the characteristics of plaque directly from a standard CT scan, giving doctors this unprecedented insight into a patient's risk profile. This moves them from just being a diagnostic tool to a tool for risk stratification. It dramatically increases the value of their entire platform, and more importantly, it opens up an entirely new revenue stream. This is how you widen them out. And they are not wasting a single second bringing it to market. Just look at the aggression in this rollout plan. They are targeting 1,000 accounts by the end of 2026. Now, for some context, it took them 8 years to reach that same milestone with their flagship FFRct product. They plan to do it in less than 2 years with Plaque. They're leveraging their existing commercial footprint and leaning heavily into medical education to drive adoption as fast as possible. They have data readouts coming that will act as major catalysts, and the CEO's long-term vision is crystal clear. He believes Plaque will ultimately be a bigger business than FFRct ever was. This is not a company that's playing defense. It's a company on the offensive, using its current strength to build its next great engine of growth.
So there you have it. You've got the bull case, built on a powerful foundation of explosive growth and a widening competitive moat. And then you have the bear case, which points to the deep, undeniable cracks in the company's financial foundation. We've laid all the evidence out on the table. It is now time to weigh the arguments and deliver the iron verdict.
So, on one side of the scale, you have a massive opportunity. That 40% year-over-year revenue growth, that's the real deal, and it's supported by a data moat that looks nearly impossible for anyone else to breach. You've got a confident management team and a major new product catalyst in Plaque. This is the blueprint for a market leader. But on the other side of that scale, you have a trap. That unprofitability isn't just a footnote, it's a gaping wound. The cash burn is extreme, and the market itself is telling you it's skeptical. A great plan means absolutely nothing if you run out of fuel before you reach your destination. The execution risk here is huge. And that's really what this entire paradox boils down to. The verdict isn't a simple buy or sell. The investment thesis for a company like HeartFlow hinges entirely on one critical factor: your time horizon. If you are a trader or an investor who's focused on the next 2 or 3 quarters, then the financial strain and that high cash burn are likely deal breakers. The path forward is just too uncertain and the losses are way too severe. However, if you're a long-term investor with a 5 to 10-year outlook, the story looks completely different. Those short-term losses, they become investments in building that impenetrable moat and securing a dominant market position for the next decade. So ultimately, it comes down to this single, crucial question for your own portfolio. Are you looking at the ground floor of a future medical technology giant, a company that is willing to spend whatever it takes today to build a fortress that will stand for generations? Or are you looking at a spectacular castle that's being built on a foundation of sand, destined to collapse under the weight of its own immense losses before it's ever completed? We've shown you the blueprint, and we've tested the materials. Now it's up to you to decide if the structure is built to last.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.